Most people believe that when a stock trades under 20 cents, the story is already over. They assume the market has spoken, that smart money has moved on, that whatever potential once existed has already failed. So they scroll past it without stopping. But here's the uncomfortable truth most investors don't like to admit. The market doesn't always price risk and opportunity at the same time. Sometimes it prices fear first, and sometimes that fear hides something worth understanding. This stock is trading around 18 cents, not because it doesn't have a product, not because it has no users, but because the market is deeply unsure whether it can survive long enough to matter. And that uncertainty is exactly where speculative investors start paying attention. Because the biggest returns don't come from certainty. They come from moments when probability and perception are out of sync. Before we talk about any company, we need to talk about a problem that is quietly getting worse. A problem tied to artificial intelligence, automation, and the future of work. Everyone talks about AI replacing jobs. Very few people talk about how talent is actually discovered and connected to opportunity in this new world. As systems become more automated, the value of being visible increases. If you are not seen, you do not exist in the data. And if you do not exist in the data, you are not part of the future. For decades, talent identification has been inefficient. Whether in sports, education, or early career pipelines, discovery has relied on outdated systems. Personal networks, geography, access to resources. If you were in the right place with the right exposure, you had a chance. If not, you were invisible. That model worked in a slower world. It breaks down in a digital one. AI does not fix this problem by itself. In fact, it can make it worse. Algorithms can only evaluate what they can see. If data is missing, incomplete, or biased toward those already visible, opportunity becomes even more concentrated. That creates a bottleneck. And bottlenecks in systems that are supposed to scale always create opportunity for new infrastructure. Traditional solutions try to fix this with more scouts, more manual work, and more fragmented platforms. That approach does not scale. It is expensive, slow, and inconsistent. What is needed instead is a structured digital layer that organizes talent information, standardizes evaluation, and makes discovery searchable, not flashy, not revolutionary, just functional infrastructure that fits the way decisions are actually made today. This is where the story starts to narrow, because one small US company has quietly been working in this exact space. A space most investors never think about when they hear the words artificial intelligence or future technology. But infrastructure does not have to look futuristic to be important. Sometimes it just has to work better than what came before. That company is called Signing Day Sports, Inc. At the time of this video, its stock trades around 0.18 per share. That number alone explains why most people ignore it. It sits firmly in penny stock territory, volatile, unpopular, easy to dismiss. But price does not explain the role the company is trying to play. Signing Day. Sports operates a digital platform designed to help student athletes get discovered by colleges. That may sound niche, but the underlying problem it addresses is much broader. Colleges need efficient ways to identify and evaluate talent. Athletes need access and visibility. The platform acts as a centralized system where performance data, academic information, and profiles are organized in one place. The technology itself is simple by design. Athletes create digital profiles. Their information is structured. Coaches and institutions can search, filter, and review candidates without relying solely on personal connections or limited scouting events. This reduces friction on both sides. It does not guarantee success, it increases access. What makes this useful is not complexity, it is alignment with reality. Institutions already make decisions based on data, time constraints, and limited budgets. A platform that saves time and expands reach fits directly into those incentives. It is not about replacing human judgment. It is about making that judgment more efficient. Now let's pause and be honest. This is not a massive company. It is not profitable. Revenue has been relatively small. The business is still in a development and growth phase. Cash management matters. And like many microcap companies, it faces real risks related to funding and dilution. These are not minor details. They are central to the investment case. This is where many videos turn into hype. This one does not, because ignoring risk does not make it disappear. If the company cannot grow adoption, manage expenses, and demonstrate a clear path forward, the stock can absolutely go lower. That is the reality of penny stocks. Survival is not guaranteed. So why even talk about it? Because stories like this are not about certainty. They are about timing and probability. And timing matters because broader trends are slowly moving in the company's direction. Digital adoption in education has accelerated. Institutions are under pressure to justify costs and outcomes. Remote evaluation is more accepted than ever. And pathways from education to opportunity are being scrutinized as automation reshapes the labor market. Government policy also plays a role. There is increasing emphasis on transparency, compliance, and standardized processes in educational and athletic programs. Platforms that help organize data and reduce manual inefficiency quietly benefit from these shifts. Not overnight. Gradually. Signing day. Sports is not trying to dominate an entire industry tomorrow. Its challenge is much simpler and much harder at the same time. It must prove that its platform is useful enough to become sticky, that institutions will use it consistently, that athletes see value in participating, and that the economics can eventually support the business. There have been developments worth watching. The company has explored strategic initiatives and potential expansions. It has signaled interest in aligning with broader digital infrastructure opportunities. These are not guaranteed catalysts, they are signals. And in speculative investing, signals matter. At 18 cents, the market is clearly skeptical. The valuation reflects doubt, it reflects risk, it reflects the possibility that this story never scales. But it also means expectations are low. And when expectations are low, incremental progress can change perception faster than most people expect. This is not a recommendation. It is not financial advice. It is a case study in how overlooked corners of the market often contain unresolved questions rather than resolved failures. The upside exists if execution improves and adoption grows. The downside exists if funding dries up or momentum stalls. Both outcomes are real. The reason most people ignore stocks like this is not because they have analyzed them and rejected them. It is because they never looked past the price. And price alone is not analysis. It is a starting point. In the end, this is a long-term, high-risk, speculative story. It is about infrastructure, not hype. About access, not guarantees. And about understanding risk rather than pretending it doesn't exist. Whether it belongs in a portfolio depends entirely on risk tolerance and time horizon. If nothing else, stories like this remind us of one thing. The market does not reward attention. It rewards understanding. If you found this breakdown useful, take a moment to like the video, share it with someone who studies small cap stocks, and subscribe to Investor Codes for more deep dives into overlooked investment ideas.